This is about as good as it gets, guys. Literally everything is working right now. My name is Hamilton. I'm here at the Trading Initiative, and in this week's Markets in Focus, wrapping up March 22nd, 2024, I want to go through last week's moves and potentially what we can expect over the next week. First things first, I want to give you guys a shout out, particularly those of you that are following me on YouTube for the last year. The channel is just now starting to catch some popularity. We're starting to get views up in the multiple hundreds. And I've gotten a bunch of emails over the last 2 weeks that for those of you that have been following for a year or more, your portfolio is either at all-time highs or is very close to all-time highs just by simply following the analysis of we are in a secular bull market and a cyclical bull market. Don't sell your best stocks early. Don't try to time the top. It's incredible how many people overcomplicate the process in uptrends. They want to be the guy to be able to time the top and absolutely, nail the exit. And realistically, what happens in these strong uptrends is you get left behind. You sell the best stocks and it's impossible to get back in without risking some nasty level or not knowing where to get back in. So shout out to you guys inside of TTI. This has been our best quarter in 4 years, the first quarter of 2024. We have up anywhere between 50 to 150% year to date on portfolios already, depending on the amount of risk people are willing to take. It's really been an incredible year so far, going back, almost 15 months just to be long. Just be long the market in a cyclical bull market, the strongest stocks, and just wait. It's been great. So congratulations, you guys. I do appreciate the emails. And if you're new to the channel, you're about to get dosed, unbiased, unopinionated viewpoints on the market. We stick strictly to price, absolutely nothing to do with what I think is going to happen. So welcome. First things first, we want to start off with this intermarket analysis, as we always do. Growth up the most last week, Q's up 3%. On weeks where the Federal Reserve is scheduled to speak, particularly around interest rates and other key decisions, it's reasonable to expect that the market is going to move. It's volatile, right? That makes sense. Higher beta stocks. So stocks, if the S&P 500 is the benchmark, higher beta means stocks that will move more than the benchmark, right? So if SPY moves 1, higher beta is going to move in some multitude of 1.1 or higher, right? Up to 5 or 10, depending on how volatile you get. Generally, growth stocks are going to be higher beta stocks. So the week, right, the interest rate decision came out and the S&P 500 enjoyed it, right? It popped up. It's up, was it 2.29%? It's reasonable to expect higher beta stocks are also going to respond in the same direction, but more. That makes sense, right? Hopefully volatility isn't a foreign concept to you guys. And if it is, we put out videos on this like every week on volatility and how to use it. So it's a great week to be long in towards that interest rate decision. Once again, the Fed came out unbeknownst to everybody, supposedly, did not touch the interest rate and interest rates, and the market loved it. So higher beta stocks jumped up. Like I said, the Q's up 3%, S&P 500 up 2.29, Midcaps, which we're going to talk about a lot in this video, up 2.15%, the Russell 2K up 1.5%. Everything is working. Bonds even caught a bid. Yields are down. Oil's down. BTC slight down, but that's okay. Understand that if you're trading a volatile asset in primary uptrends, whipsaws tend to happen when trades get crowded. Right now, at that all-time high pivot, Bitcoin is crowded. Still totally expected to continue to break out over the long term with a minimum price target of $100,000. And that's just based off of a Fibonacci extension over a large range. That's it. It has nothing to do with what I think about Bitcoin. It just has to do with math. We think 100K is base case for BTC, and actually it's probably going to go a little bit higher. Copper, slight down as well, but overall a very, very bullish week to be long the stock market. Let's go ahead and move into U.S. sectors really quick. What we're going to do here is we're going to start with year to date. We're going to go to 1 month, and then we're going to go to 5 days. And I just want to show you guys something really quick, something that we noticed inside of TTI last week. So right now, comms are up the most year to date. Who would have expected that? Think of your Metas, think of your Googles, think of your Netflix, even some of the old telecom, like the older telecom companies, T-Mobile, et cetera, are performing decently well. Disney is just now starting to join the bull party as it breaks into a yearly high. Energy, though. Who would have expected energy would be leading into Q2 of 2024? Not us, to be 100% honest with you, but we do have positions, and that goes right back to not willing to trade our opinions or biases. We are trading price. When price tells us that something is breaking out and we need to take advantage of it, we start to take advantage of it. And then typically news comes out anywhere between two weeks to 2 months later, and it confirms our thesis, right? Which is entirely based off of price. Financials up 10.57%, industrials up 10.18%. But what's striking to me is the fact that tech is now down year to date against SPY. SPY up 10%, tech down up 9.24, and consumer discretionary up 2.41. I want to point something out. Last year was the year of buying Mag 7 and waiting. That was it. Buy big or mega cap growth stocks and just wait. That was the playbook. This year, at least through Q1, is completely different. If you would have just bought Mag 7, 3 of those Mag 7 stocks have actually underperformed SPY. 1 or 2 of them are right around SPY, and then there's NVIDIA up at the top and Microsoft as well. But realistically, just buying Mag 7 and waiting has not given you a whole lot of alpha. This year has been completely different. Owning the energy stocks, owning the financial stocks, owning the industrial stocks. As a matter of fact, if we go back to 1 month, look at this. Value has outperformed growth over the last month. We talked about this. We put a video out a couple days ago, our newsletter out. There's rotation happening under the surface. Now, the $1 million question, once again, is not, is there rotation happening? We can see it. The $1 million question is, how long will this rotation last? And is it worth closing our really good entries in tech stocks, consumer discretionary stocks, and communication stocks to go and chase some of these energy, material, industrial-related breakouts? We don't know if that's the case. So we've taken some beginner positions in energy, we've taken some beginner positions in materials. We're not willing to close those really good tech entries yet to chase the other areas of the market because we just don't know yet whether or not this is going to be just a quarter-over-quarter sector rotation or if it's going to manifest itself into a longer move. My gut, which we don't trade off, but my gut says it's not. It's going to remain tech through semiconductors in particular. One thing I want to point out on the 5-day, and this is where things get really interesting to me at least, we were just talking about how higher beta stocks tend to perform better during key weeks where key decisions come out from the FOMC, or not FOMC, Federal Reserve, excuse me. And in this case, the market liked it, and so higher beta stocks liked it. But generally what you see is high beta growth stocks tend to outperform. And we haven't seen that yet with tech. As a matter of fact, industrials, and up until Friday's close, we had financials, and we had a bunch of these value areas actually respond better than some of the traditional higher growth stuff that responds better. So once again, it's not necessarily, to say sell all your tech stocks right now. There's definitely underperformance, relatively speaking, across different sectors, but it's something that you should be aware of, that generally tech, consumer discretionary, and communications lead the market by a very large margin on weeks like this where the market liked it, and they're not this time. They're not. They're leading, but not by a lot. So that's just a change of character. Let's go to year to date on U.S. industries. Don't want to spend too much time, but once again, semiconductors breaking up into new highs potentially. This is the reason why we don't want to close our semiconductor plays. We don't want to do it yet. I think it's stupid, particularly if you've been taking any of the trades that we've taken and you have free positions. If there's free positions on the books and you want to try to time a top and get back in on a pullback, be my guest. We don't want to do it. If we've been able to flip these positions free by selling half at 100%, we are realistically holding lotto tickets through Q2, Q3, and Q4 of this year. If semiconductors decide to run again, which we think they will, we think we're in the second year of a cyclical bull market being led to the upside by semis. Semis led last year. Semis are leading this year. We have incredible entries. There's no reason for us to try to time this top. We want to go ahead and just leave these alone. Let's see how far these things go. Once again, they're starting to catch a bid over the last few sessions and potentially propping back up into new highs. Who knows? But underneath semis is a huge gap down towards oil, insurance, home builders, oil, and internet names all the way down here. AMLP, these are your oil, gas, pipeline names. You have your insurance names, home builders, and your oil, gas, and exploration and production stocks. So there's a huge variance in what types of stocks you want to own right now from the tech space. Not Apple, right? We don't want to be going out and owning Apple. As a matter of fact, Apple is causing IGV, the software ETF, the industry group, to underperform on the year because Apple sucks so much. The semiconductors are where you need to be playing ball, but at the right levels. Don't just go and indiscriminately buy those. But outside of semi, there is a lot of opportunity in some of those value areas, which we were talking about in the sectors. We want to go ahead and focus on some of these energy, materials, and financial names that are breaking out because we don't know how long this is going to last. We want to catch a piece if it's available. So semis, once again, over the last month, leading. You don't want to give those up, guys. Fuck what everybody says. AI bubble, blah, blah, blah. Let them be right 3, 4, 5 years from now. But right now, it's money-making time, and semis are in the lead. Do not try to outsmart this, guys. I'm telling you, it's worked for us for the last 15 months. It's probably going to continue to work for us. I'm just telling you, this is how trends work. Trends tend to trend longer than most people expect, and most people don't expect this to continue. So I'm going to continue to be long. I'm going to be a little contrarian here. Oil services up second, home builders up third, and gold miners up fourth. So once again, this is different, right? Last year we saw tech across the board, communications across the board, consumer discretionary across the board, and now we're starting to see some sector rotation into some of those value areas. Once again, I just want to point out on the 5-day that post interest rate decision, generally we get those higher growth, higher beta areas that move more. And in this case, for the industry groups, it's true, right? So semi's up. This is very, very indicative of high growth, high beta stuff right here. Solar, because solar sucks, but generally when the market moves, these are going to move even more in the direction of the market. So solar is up 3.5%. Jets, internet, software, that's what we want. We want those areas to lead the market. In a bull market, it's easier to trade. People generally like to trade those a little bit better. There's more liquidity on the chain, etc. But home builders, we have positions in home builders. I don't see too many people talking about home builders. We have one in particular, AZEK, AZEK, breaking out into new all-time highs. So we're able to go ahead and grab that in the whole builder space. I want to focus really quick. This is going to dominate the next probably 15 minutes of this video. Midcap growth year to date is now outperforming everything. Midcap. If you've been following our content on Twitter or newsletter, you know that we are long a substantial amount of midcaps. I'm just going to leave it here and we're going to talk through it via TradingView right now. All right. So just look at midcaps. If we go to 1 month, you'll see midcaps once again. Midcaps. They are outperforming everything. And we've been buying them for the last 3.5 or 4 months, going all the way back to November and December in certain circumstances. We're going to look through those. So let's go ahead and flip over to TradingView really quick, and let's update the levels on the indexes. SPY, Qs, IWM, we're going to stick to the weekly here. If this were anything else, everyone's screaming about how this is the worst thing ever. The S&P 500 closing again at a weekly all-time high. If this were a stock and not an index, everybody would say you're an idiot. This is incredibly bullish. That breakout right there, that pivot, right? This double top that everybody was trying to short supposedly, what happened to be the absolute best opportunity to go ahead and grab this. As a matter of fact, this is the 7th best start in the last 80 years in the S&P 500, and we are teetering on 6th. So if you missed that pivot and you've been short this year, it's been a very rough year for you. If you haven't been short and you've just, if you've been a dumb bull and bought the breakout on an uptrend, you've loved this year. For those of you that don't trade a lot, you have longer term portfolios, you don't mess with your 401ks, this last quarter has been amazing, and most of you are probably sitting near all-time highs. It's been incredible. Now, does that mean that the S&P 500 is just going to continue to go up to 550, which is our original price target that we put on this breakout? Probably not. I'm not going to sit here and say that these things are sustainable with this type of momentum, but it has so far. So we're not going to rule it out. I would not be surprised to see once again some sort of pullback above, the 500 area. Potentially, we could get a pretty deep corrective phase and still have a primary uptrend if we just shift click down 10%. So by the books, a correction is around 10%. Could we see a 470, 465 retest? Absolutely, we could, but there's no reason to expect it's going to happen next week. Every single person that said it's about to happen, it hasn't happened yet. And if you're just planning for just that scenario, you are missing out on literally a historic run. Let's look at the Qs. It's more or less the same thing. The Qs were closing once again at a weekly all-time high, looking like it wants to hit the 490 to 500 area. Can you imagine the markets up at 490 or 500? I can. Could it happen this year? Absolutely. It absolutely could. We had no idea that this was going to move so fast this year, and yet here we are taking advantage of it. Because we don't try to time the top. We don't try to outsmart the market. We've been able to take advantage of this. So here, once again, the Q is taking out 2 weeks of drawdown in 1 week and pressing into new highs. RSI is screaming at us that this is a bullish momentum regime going all the way back to January of 2023, guys. January 2023, the break above the 50 in the RSI gave us conviction, part of it, to start going long, and we did. As a matter of fact, go back and look at the videos we posted on YouTube back in January and February of 2023, where we were poking fun at the bears thinking that there would be new lows, and they never came. We were long for the last 15 months, and it's reflected in our portfolio year to date. Small caps as well, 2-year highs. We placed 2-year highs on the close. Well, almost actually. When I was originally recording this at the beginning of Friday, we were, but still, we have 2-year highs coming in on small caps here. As long as we're above 200, we love this. They want to play ball. Small caps want to join the party. This is what I mean by everything is working. We have the Qs. We have SPY, we have IWM, everything is working. And as a matter of fact, let's look at equal weighted ETFs. Equal weight S&P 500 is at all-time highs this week. Mathematically, it doesn't make sense to say market breadth sucks if equal weight ETFs are breaking out into new highs. It doesn't make any sense. The argument of Mag 7 stocks or just the biggest stocks in the market are working is a lazy and wrong take. That's it. There's no other way to put it. These equal weighted S&P 500s, the equal weighted, for example, the Qs, let's look at that. All-time highs over the last few weeks. And we're holding the previous all-time high pivot. Guys, this is incredibly bullish. Incredibly bullish. There's no market breadth problems whatsoever, as a matter of fact, when you have these equal-weighted ETFs screaming at you that the average stock within these indexes is performing well. And let's go to Midcaps, which are where we're making a lot of our money right now. This is an all-time high close on MDY. All-time high close, Midcaps. So once again, this is about as good as it gets. You have equal-weighted S&P 500, equal-weighted Qs, mid-caps breaking out into all-time highs, and you have small caps joining the party into 2-year highs. Everything is working right now. Everything. As a matter of fact, I can prove it to you one more way. The Value Line Geometric Index, VALUG, this gives you a decent idea of the average stock in the market. I think this holds around 1,700 stocks. So if you want just a broad view, equal-weighted 1,700 stocks in the market, here it is. This is a 2-year high in Value G, right? Your Value Line Geometric Index. The average stock in the market is now participating in this rally, a year into it. So for everybody that was sitting here saying that the average stock or market breadth sucks, they're not participating, you're wrong now. At this point, that is no longer something that you can say. Mathematically, you are wrong. So Value G breaking out, MDY breaking out, QQEW, RSP at all-time highs. Let's look at the dollar really quick. Obviously, we understand that the dollar holds a lot of sway over the market. We understand that this is inversely correlated with the market right now, right? Over the last 2+ years, every time the dollar goes up, the market goes down. Every time the dollar goes down, the market goes up. But guess what? The market's been going sideways, and the index is going up. So just to prove this to you really quick, we can look at the S&P 500. Turn this to the line chart. And you can see whenever the dollar peaks, the market tends to find a floor. Dollar peaks, market finds a floor. So this is where we're at right now. Where are we within this broad range? We're pressing up in towards the upper bound, but as of right now, because we're just holding the sideways consolidation, the market has been able to just continue to run. What we're worried about with the dollar inside of TTI, and it's not yet, too many people, I think, stress over every single move in the dollar. Yeah, that makes sense if you're day trading or scalping, but you need a longer time frame if you're swing trading here. We're worried, if you can say so, above the 107 area, and we are elated underneath the 100 area. As long as we're within this range, we expect the market to continue to do what it's been doing over the last 15 months, which is go straight up, basically, right? If the dollar breaks to 107, we think that the party might be over, or at the very minimum, coming to a short-term end, and there's going to be definitely some volatility and some downward pressure in the market. But if we break below the 100 area, we think that that's going to cause stocks to continue to run at a pace that puts Q1 of 2024 to shame. Right? As of right now, it's just incessant chop to the right. That's it. But we're actively watching it. Let's talk about some ETFs that broke out in all-time highs, some sector ETFs. How about financials? Who would have expected this? A year ago, almost to the day, regional banks were supposed to implode, and our life was over. The market was heading new lows. 1 year later, we are at all-time highs in the financial sector. Ironic, right? The irony always just gets me. And guess what? We've been able to catch a piece of this. As you've seen us post about JP Morgan, KKR, we've been able to grab this. Wells Fargo, Citigroup, Bank of America. Thank God we don't listen to opinions and people that tell us, that the world's about to end, and instead we just buy these horizontal level breakouts. You can learn a thing or two from this channel if you could just take the ego and the opinion out of it and just buy the breakouts and strong uptrends. So XLF, all-time high. XLB, your material sector, all-time high. XLI, your industrial sector, all-time high. See where I'm going with this? By the way, all three of these value areas of the market. So once again, we were talking about sector rotation over the last 3 to 4 months. The year-to-date chart was showing us that a bunch of the value areas were starting to pop up and actually start to outperform. And then over the last month, we've seen a lot of the value areas absolutely outperform. But at the end of last week, post-interest rate decision, the growth ETF started to pop back. XLC, new 2-year high. This is your comms sector. So this is your Googles, your Facebooks, your Disneys, your Netflixes, etc. Let's talk about almost new highs. Energy. Everything is working right now. Are we about to break out into a new 10-year high and potentially threaten the all-time high here in energy? We don't know. But we have positions and they're working, which we're going to go through in a second. So energy is an area of the market that you could actively be scanning for. Who knows if this is actually going to break out or not? Let's talk XLK, consolidating here and almost at our first PT off of the 177 area breakout. The 215 area was our target of interest. Are we going to find consolidation there? Maybe. It's been choppy over the last few weeks. This represents that sector rotation we're talking about, right? Tech, stocks, larger financial institutions might be selling off a portion of their tech stocks to rotate into some undervalued areas of the market. This is all cyclical, right? Inside cyclical bull markets, uptrends still oscillate, meaning staircase type stuff. The question, once again, is the tech sector done, or is it just taking a pause before the next leg up? We think it's taking a pause for the next leg up. That's what we think. So XLK almost up towards that first PT that we've had. And XLY actually tried to go for a 2-year high once again. I tried making this video about 2 days ago, but unfortunately it didn't turn out well, so I'm redoing it. At the time, XLY was flirting with a 2-year high, but we still are. And what's crazy to me is consumer discretionary is hitting potentially a 2-year high with Tesla weakness. Isn't that the craziest part? Tesla is the second largest holding within the consumer discretionary ETF, and yet it's underperforming, the XLY ETF itself, the consumer discretionary, is performing very well. With Tesla holding it down so much, the rest of the stocks inside of this sector are doing very, very well. Most likely, a lot of it came from retail. It's coming from retail, right? XRT, your Abercrombie and Fitches, and all the different retail-related names that are going absolutely nuts. The last ETF I want to look at, is it time to own Chinese stocks? Because everyone always asks me. No, but we do think it's closer to the end than not. We just don't want to own Queb until very minimum we're above like the 30 area. You can go ahead and try to time this. You can buy it, do whatever you want, but I'm going to tell you right now, avoiding this like the plague over the last three years for us has been a godsend. We don't have to stress over anything. This is just incessant chop within a stage 1 base. That's it. We want to own minimum above $30 to try to front run a new high. But other than that, we want to stay away from Chinese stocks. So we do think it's closer to the end than not, but not something we want to own yet. Let's talk about some stocks that we own and some stocks that we're looking at really quick. Talked a lot about midcaps, so we're going to focus on midcaps again. This is Shark Ninja, who expected this to be a publicly traded stock. I had no idea, but we bought the all-time high breakout somewhere near 54, currently trading $60. This is a free trade for us as of right now. Sweet Green, another midcap related stock that we were able to buy, the 1950 breakout. This is currently about 75% of the way through to our PT, also a free trade for us right now. We were able to close half at 100%. These types of breakouts are everywhere in the market right now, and if you can find them, I highly suggest at the very minimum paying attention to them because they are working. Shake Shack, new 2-year, 3-year high. We're able to take advantage on the COD setup. We got the pullback towards $99, currently trading $109. This is another free trade that we have on the books. Cart, one of the easiest trades we've taken this year. So you can see sitting here trying to illustrate it out for guys that are asking, when are we taking profits? We're not taking profits until we're up at $39. We closed half at 100% to turn it free. We took some profits at 32. This has been a huge trade for us. It's up 15%. We're not taking profits until we tap 39. And if we still have contracts, we're going to let them go because we have Julys. We're in the money by $3, $2, something like that. We have so much expiration. These things are up huge for us, 3, 4, 500%, depending on where you got it. Been a very easy trade. I'm not going to lie. Just a layup of a trade. Buy the 28.5 breakout and let it go. 2 more. Hood. Fantastic trade for us as well. I mean, all of these setups are relatively the same. I'm sure you guys can see it. We bought the 13.5 breakout. Here we go. We were able to take some profit at 17, and we're up into new highs, 2-year highs in Hood. This is another trade that's up relatively large for us and free, so no reason to try to time that top. And Kava, the 58 area, but we actually grabbed it off of the 52 area breakdown to front run the all-time high. So Kava is another free trade for us, up huge. All of these are mid-caps, though. The reason why I showed you that is all of these are mid-caps, and they're relatively the same setup. Buy them. This is what's working in the market right now. You don't need to reinvent the wheel. Just scan for strength and then buy the things that are showing leadership qualities, the all-time high breakouts, the horizontal level breaks, and the stage 2 uptrends. These are stocks that you can own relatively easy and profit from. ARM, huge position. We have a huge position in ARM. It's up gigantic because we bought it back here at 56.5. We were able to add in during this consolidation, and we caught this entire move to the upside as a group. It's been a fantastic trade for us. Here we are consolidating. Is this a continuation fractal? We expect yes. We expect yes. I don't care about the lockup period. I don't care about anybody selling. It doesn't. That type of shit does not matter to me. I care about what price is telling me. And as of right now, there's no reason for me to try to front run this exit. We're already up over 1,000% in the contracts that we still own. A lot of us have shares in this as well. I expect this to resolve to the upside. This, to me, looks like a consolidation fractal on the upside of a flagpole. I'm very okay with being wrong. My invalidation price is going to be somewhere around 110. At that point, I'll take profit off of the contracts that I have and look to re-enter on any resumption of the uptrend, but I don't want to try to time the top. If this does continue to break out, this is going to be anywhere between a 1,500 to 5,000% win because we have July contracts. They're absolutely huge right now, and we have a huge head start. It's free. We've taken profit. We don't want to try to time this. TSM, we expect to also bounce as well. We have a free trade in this. We were able to open it 2 or 3 weeks ago. Pulling back, finding support at previous all-time high. No reason to try to once again time the top here. We expect this to continue to break out towards 185. MU, we had a position in. We still have a position in, obviously. Gapped up big because of earnings. We did not play this because of earnings, but we're not going to give the money back that we just made off of it. Thank you, Mr. Market, for giving us the big move off of earnings. MU causing the entire semiconductor space to continue to pop. So congratulations to the guys inside of TTI and any of you that grabbed MU. This went out into the newsletter a few weeks ago. If you were able to grab it, this is a huge win for you, and you have a huge head start for the overall price target here at 126. So good stock. Good job, excuse me. We expect CrowdStrike once again. This looks just like ARM in the case of a consolidation fractal up at all-time highs. It's a consolidation fractal. We expect this thing to eventually break above 330 and make a run towards that 375 price target. We're currently in this. App is a trade that is absolutely huge for us. We almost tapped 1,000% last week, but we didn't. It was about 950% and then pulled back end of day on Friday. This started as a mid-cap. Started as a mid-cap and is now a large cap, and we're up almost 1,000%. We have July's on this. There's no reason, once again, to try to time the top. We're not closing any of this until 100, or there is some form of market structure breakdown or momentum loss. I mean, this is what we do inside of TTI. We catch these things at key levels and we let them work for us. There's no reason to try to time the top. We're up almost 1,000% in app, and we have 4 months of expiration still on this. There's no reason to try to time the top. Uber is the last one here. We expect Uber to be at all-time highs relatively soon, and we have an overall price target of 95. Once again, we were able to buy the 64 area breakout. All of this stuff is very, very simple, guys. We don't try to reinvent the wheel inside of TTI, and if I can impart any wisdom on you guys, it's just participate in bull markets at key levels. That's it. JP Morgan, we bought the all-time high 1757. Almost there at the PT. We're looking at the 200 to 210 area as our first profit target. We're almost there. It's a 400% win for us in a financial name, which is pretty crazy. Valero, did not expect this to act this way, but I'm happy. We're up multiple hundreds of percent on Valero and almost at that first PT at 178. It's a completely free trade. This is one of those energy stocks that, once again, we took advantage of. It's a very simple setup. It's just a consolidation fractal. If you want to call it an ascending triangle, feel free, whatever tickles your pickle. We just want to own this above 147 with a price target of 178. All-time high. Energy sector was showing a push. We wanted to go ahead and grab position in it. MPC was another one that we were able to grab off of this area breakout. And this is the leading stock inside of the energy sector. If you didn't know, now you know. Go ahead and scroll out. MPC is absolutely destroying the energy sector. This is what you wanted to grab. And as a matter of fact, we did. We grabbed this last year. It was a pretty good win, underperformed what we expected because the energy sector actually pulled back. But since then, MPC is absolutely destroying all of its competitors. And we were able to grab this. It's up 500%. Once again, this is an energy trade, and we're up 500%. That normally doesn't happen. Oops, not CrowdStrike. STLD. This is our materials related play that went out in the newsletter about a week and a half ago, 2 weeks ago. We wanted the 135 pivot, currently trading 144. Not a free trade yet, but the shares should be up at break even. So for those of you that are trading shares, this should be a relatively risk-free trade at your stop at break even. For those of you in contracts, it's up about 50%. So we want it to continue to go before we take anything off. Abivai is the other one. We like this name. We expected more out of it. It popped up about 50, 60%. It's back now at break even. Listen, if Abivai fizzles out, we're going to go ahead and take the loss underneath 175. Totally okay. We don't expect it to lose, but if it does, that's fine. But we wanted to take advantage of healthcare because healthcare was also at all-time highs and is, but Abivai, for whatever reason, just fizzling out. So this is another one of those value areas that we wanted to take advantage of. We grabbed a position. It worked. Now it's not. Let's talk about 3 trades that we actually want to put on this week, and we started putting on Friday. RCL. Setup is very, very simple, right? Royal Caribbean. We want exposure into consumer discretionary, and this is a casino, hotel, cruise, leisure leader, right? So we want to own this thing above 135 with an overall price target of anywhere between 200 and 205. It's a slow mover on the daily if we come into the daily here, so we want plenty of time on the options chain if that's what you're using to attack this. Remember the difference between duration and momentum. This particular stock is probably not going to move 20% in the next 2 weeks. Just not that type of stock. But it absolutely could move 20% over the course of 2 months. And if you're okay with leaving some of these slower positions in your portfolio, which we absolutely are okay with inside of TTI, they can be huge. JP Morgan's a great example of that. JP Morgan is up 400 or 500% for us right now, and we opened it January 4th. Here it is, March 24th. So if you can just buckle down and hold these things through some of the short-term volatility at the right levels, right? You own them at the right levels. You can profit without really having to worry about these things destroying your portfolio. Just like RCL generally is not going to move 20% in 2 weeks. It's also not going to gap down 20% and destroy your overall position, right? So we like RCL above 135. with a price target of 205 to 206, something like that. If you're buying contracts, please go out. We're looking at September, October, November, December. I don't remember exactly which one we opened up, but we like it. CAR is another one that's been setting up for us. We like this position as well. We like it above 60 for a price target of 75 to 76. Once again, it's a little bit lower volatility. It's a value-related name. We really like the setup, though. This makes total sense to us. We want to own it above 60 bucks. It's that nice big round number and targeting the 75 area. You can run this exact trade setup, how you see it with the 786 as your fib, 786 is your stop, 75, 76 areas your take profit, 60 bucks is your entry. It'll give you about a 2.8 or 3 to 1 setup every single time. Rising 200-day moving average RSI hugging the 50 but not breaking down. We think it's a decent opportunity at diversifying your portfolio in a stock that is producer manufacturing industrial machinery. So it's outside of that growth area. Low is the last one that we are looking at right now. We're in so many positions right now, by the way, that it doesn't make sense to just continue to pile these on. We're in a lot of free positions in the growth area of the market that are performing well. So as I go through these, I want to point out that all of these setups are looking like they want to break out. It does not necessarily mean that we're going to own all of them, depending on how many positions we already have open, right? So low here is a consumer discretionary retail related name, 1.6 ADR. So once again, another slower move, right? So we have CAR, CARR, RCL, Royal Caribbean, and Lowe's, LOW. All three of these are a little bit lower volatility breakouts into all-time highs, though, right? So low, we want to own it above 26150 with the price target of pretty much above 300. We want to run the stop a little tighter, sub 250, so we can skew that risk to reward, in our favor, 4.9 or 5 to 1 in this particular setup. So you can run the setup exactly like you see it here, above 261.5, targeting 315 to 318 with a stop sub 250, something like that. We'll give you an opportunity at a 5 to 1 setup. You can go out on the chain. The chain's going to be a little bit sparse, though. So if you want, once again, make sure you buy time on these duration style plays. Guys, my name is Hamilton. I'm here at the Trading Initiative. If you like this type of content, please like and subscribe. Leave a comment below. And if you haven't already, sign up for the newsletter. We put out newsletters almost every single day. They're free. If you don't like it, you can unsubscribe at any time. But I write them personally at the end of every session, and I try to pack in as much value as I can with a quick read, 2 to 3 minutes. It shouldn't take up a lot of your time, but it gives you an idea of things we're looking at or other areas of the market that maybe other people aren't talking about. So hopefully there's alpha there. Once again, if you like this type of content, please like and subscribe. Leave a comment below. Good luck next week. Catch you next video.